Next, we discuss the solvency ratio. The solvency ratio is also known as the leverage ratio. The financial strength indicated by the soundness of the financial resource of an organization to perform its operation in the long run. The parties associated with the organizations are interested in knowing the financial strength of the organization. The financial strength is directly associated with the operational ability of the organization and its efficient management of resources. It involves the debt-equity ratio. This ratio indicates the proportion between the shareholders' fund and the total borrowed funds. The ideal ratio of the debt-equity ratio is 1. In other words, the investors may take debt-equity ratio as quite satisfactory if the shareholders' funds are equal. The debt-equity ratio is calculated by debt divided by equity. It's also indicated its name. High ratio indicate that the claims of creditors are higher as compared to the owner funds. For a low debt equity ratio may result in a higher claims of equity. Next, capital gearing ratio. This ratio establishes the relationship between fixed interest bearing securities and the equity shares of a company. The capital gearing ratio is calculated by fixed asset bearing securities divided by equity shareholders of a fund. Fixed asset bearing securities carry with them fixed rate of dividend or interest and include the preference shares and the debentures. Next, financial leverage ratio. The financial leverage results from the presence of fixed financial charges in the firm's income stream. Financial leverage ratio is calculated by EBIT divided by EBT. EBIT means earnings before interest and tax. EBT means earning before tax. So we calculate the financial leverage ratio by EBIT divided by EBT. Thus, fixed charges do not vary with earnings before interest and tax EBIT or operating profit. They have to be paid regardless of the amount of earnings before the interest and tax available to pay them. After paying them, the operating profit EBIT belong to be the ordinary shareholders. Neither a very high leverage nor a very low leverage represent the sound picture. Next, the proprietary ratio. This ratio establishes the relationship between proprietor's fund and the total tangible asset. The ratio of the particular importance to the creditors who can find out the proportion of shareholders' fund in the capital asset employed in the business. The proprietary ratio is calculated by proprietor's fund divided by total asset. A high proprietary ratio shows that a concern is less dependent on the outside funds for capital. A high ratio suggests sound financial strength of a firm due to greater margin of workers, owners' fund against the outside source of finance and the greater margin of safety for the creditors. A low ratio indicates a small amount of owners' funds to finance total assets and more dependence on the outside funds for the working capital. Next, the interest coverage ratio. This ratio measures the debt servicing capacity of the firms in so far as fixed interest on long-term loan is concerned. It is determined by dividing the operating profit or earning before interest and tax EBIT by the fixed interest charge on loan. The interest coverage is equal to EBIT divided by interest. This ratio, as the name suggests, shows how many times the interest charge are covered by the EBIT, out which they tell will be paid. And next, from the point of view of the creditors, the larger coverage, the greater ability of the firm to handle fixed charges, liability and more assure the payment of interest to the creditors. In contrast, a low ratio is danger signal that firm is using excessive debt and does not have a ability to offer assured payment interest to the creditors. The next is the ratios from the shareholders' point of view. First one is the preference dividend cover. This ratio expresses the net profit after tax as so many times of preference dividend payable. The preference dividend cover is calculated by net profit after tax divided by the preference dividend. Next, the equity dividend cover. This ratio gives an information about the net profit available to the equity shareholders. This ratio expresses the profit as a number of items of equity dividend payable. Equity dividend cover is calculated by net profit after tax minus preference dividend divided by equity dividend. And next is the dividend yield on equity shares or yield ratio under the shareholders' point of view ratio. This ratio interprets the dividend as a percentage of market price per share. It is calculated as dividend per share divided by market price per share into 100. Next, the price earning ratio. What is meant by price earning ratio? This ratio tells how many times of earnings per share is market price of the share of a company. This formula for calculating the price earning ratio is market price per share divided by earning price per share.